I want to dive a whole bunch deeper on the Fed in just a little bit. But if I asked you, are you more surprised that rates remained as low as they did throughout this entire year, or that stocks remained as powerful as they did throughout this entire year? What would you say?
A little bit of both. I thought that we were together in March of this year, and the 10-year Treasury was at 260 something at the time, and I said it's going below 2.25, but not below 2. And I was dead right about that. Actually made it all the way to 202, so it almost made me a dishonest person, but it did hold the line. But I really thought we would take another look above 260 this year, and that didn't happen. And it looks like it's not going to happen because time's running out. So I thought with that view, I didn't think we'd go above 3, so I was largely right on the range this year. But I did think that push up above 260 might have stalled the stock market. But since that move never happened, the stock market stayed remarkably strong. I mean, this is the most amazing year for investors, maybe that I can even remember in my career, which is pretty long now. I mean, if you threw a dart at the world equity markets, you're unlucky if you hit the S&P 500. You're unlucky if you hit the Dow, and you're up, like 20% types of numbers.
Because it's underperformed many of these other markets around the world.
Absolutely. And one of our strongest convictions for the year was foreign markets, particularly emerging markets, ex-China, were really the place to be. That was my recommendation, actually, at the Stone Conference.
Right. It was that pairs trade that you had.
Yeah.
Right. Go long.
It worked
markets.
spectacularly well until recently. It's worked well since the Stone Conference, but it was
at least one side of it.
Well, the pair trade. It's a pair trade with leverage, and it's worked.
Sure.
It's had good returns, but it's all about the dollar, and I think the dollar remains a very important variable as we move forward into 2018.
It's been the calmest year. I think
the drawdown in the S&P from the very high day close to the very low day close subsequently, the drawdown we call it, is under 3%. That is really incredible. It happened similarly in 1995. So there's a lot of comparisons actually between now and 1995. Some people that want to remain bullish for years to come point out that there was a raging bull market from 1995 into early 2000.
Why have we been so calm?
Well, I think it's because of central bank pegging of rates and quantitative easing going on, full bore in Europe and in Japan. One of the charts that I love to reference is the nearly linear rise in central bank balance sheet holdings ever since 2011, where the Fed stopped quantitative easing back 3 years ago, and Japan and the ECB just took over the slack, and it's just a linear rise. And if you divide global market cap of the global stock market by balance sheet holdings of central banks, the big three, it's a constant. It's kind of like a law of physics almost. If you divide the market cap of the global stock market by the balance sheet holdings, you get a constant. So that's been driving things, and now the Fed is doing quantitative tightening. It's a phrase that you don't hear a lot in financial media. They call it normalizing because it sounds so much friendlier. But we called it quantitative easing when they were buying the bonds. Let's call it quantitative tightening, not to let them roll off. That's going to slow things down a little bit. But the real worry from the central bank activity would be forward about a year, because Mr. Draghi has said, astonishingly, that they're going to continue 30 billion euros per month of quantitative easing at least until September. And then he threw in, just to put a cherry on top of the cake of stimulus, he said, and negative rates well past the end of quantitative easing, which means, sounds to me, you're going to have negative rates as long as Mr. Draghi's around, which is a little under 2 years.
Are you then saying that the runway of this good feeling, if you will, in the equity market is it another year? I want you to listen to.
Seems a little too long to me to say another year, but the tax plan has been a lot of what's going on, I think. I heard a headline just moments ago. They're talking about a deal being near between the two houses. But the tax plan's a big deal. And one way I conclude that is if you look at junk bonds, take the JNK ETF. Unbelievably, it's at the same price today as it was in January. It hasn't gone up at all, with the stock market rallying like crazy. If you look at bank loans, there's an ETF, BKLN. It's actually down on the year. And down not by like a basis point. It's down a couple percent and near the low of the year. So why is that? Well, it's because there are no defaults going on right now in the corporate economy. Bank loans, junk bonds, the default rate is quite low. So relief for some companies doesn't really help junk bonds. They're already assumed to not default. So it goes into helping the potential earnings of stocks. But I think that what's going to be a developing narrative for 2018 for junk bonds and potentially stocks is right now the tax plan is viewed as universally positive. It's kind of human nature. They look for the bright side, we all do, and they say, look, this tax plan is great, corporate tax rates will come down, although it looks like they're not going to come down much in aggregate. It's going to be very different depending on different sectors. But what about junk bonds when you think about it? I mean, junk bonds are already not defaulting. There's probably going to be some unintended consequences from all of this tinkering around of the tax code, and I think it will probably harm some companies, some sectors. I saw on CNBC a couple of weeks ago there was a fellow that's running a pretty highly leveraged energy company, and he was kind of pleading for the tax plan not to go through because of some of the non-deductibility of certain interest and the like. He was saying, we're going to go bankrupt. We're going to go bankrupt if this comes through. So I think one of the unintended consequences of the tax plan is it may lead to a new narrative about defaults in the junk bond market, and may lead to a new narrative about maybe some of the wherewithal for stocks is being taken away. Think about people like me. Think about people in New York who are very high taxpayers on a state basis, who all of a sudden are getting a big tax increase.
Because the state and local
because the non-deductibility or will probably be capped deductibility at a very low level.
Right.
Those are the people that own savings. Those are the people that own stocks. Those are the people that probably have a buying program going on in stocks. If I'm correct and I'm going to receive a 7-point bump in my tax rate, which is actually about a 15% tax increase, I have a feeling that I'm probably going to be less able and willing to buy risky assets or buy all the other things that are bubbling up and maybe that side of the narrative will start showing up. I always look for that sort of a thing. When the internet came back years ago and the dot-coms came, it was one of the biggest booms of all time, turned into a bubble, and everyone saw the positives of the internet, and it was only several years later in the credit crisis that people started to realize there's some negatives attached to these things too.
We have an update, in fact, on the very latest on the tax plan with our Ilan Moy in Washington, D.C. Ilan?
Scott, Senator Orrin Hatch, chairman of the Finance Committee, just told reporters, quote, we have reached an agreement on the final version of the tax bill. He said he didn't want to release details until he spoke to President Trump. He and other members of the conference committee that have been negotiating this tax deal are meeting with President Trump for lunch this afternoon in just about half an hour or so. But Senator Hatch did say that he is confident that he has the votes in order to get this passed. Back over to you.
Okay, Ilan, thank you very much. Ilan Moy in D.C. with the very latest. Okay, so you heard Ilan, as we said. You've said this is a, quote, strange environment to be doing this tax plan to begin with.
Right. Well, the narrative that I agree with in its accuracy is that the global economy is doing better than it's done in a long time, and the U.S. economy is doing better than it's done in years. For years, we entered the new year with, oh, we're going to get 10 to 12% earnings growth in the S&P, and oh, we're going to get 3% real GDP, and year after year, those forecasts were downgraded. This year, they didn't really have to be downgraded. We got the earnings, and while we're not going to probably get 3% real for the year, we've had it for 2 quarters in a row, and GDP now at the Atlanta Fed has been bouncing around, but it's around 3% for the fourth quarter. When's the last time we had something like 3% growth for 3 quarters in a row? It's a long time. So why would you be stimulating the economy? Also, when you look at things like Goldman Sachs and other investment banks, they do things called financial conditions indices. And this is a very unusual situation because the Fed has been tightening by first stopping quantitative easing 3 years ago and then starting to raise rates 2 years ago. So we're kind of 3 years into forms of tightening. And usually by this time, you have much tighter financial conditions. But these indices actually show some of the loosest financial conditions in this cycle. And the reason is that a lot of these financial conditions indices use volatility as a major input. The VIX for the stock market and the MOVE index for the bond market, and both of them are at extremely low levels. So that's helping these conditions. So it's weird to have loose financial conditions from Goldman Sachs, 4.2 nominal GDP. The last quarter was 5.5 nominal GDP if you annualize it. So, you know, it's kind of a strange thing to be throwing stimulus from fiscal policy on top of the mix.
There are some very smart investors who are also wondering what the implications are going to be of you're doing a tax cut while at the same time you're on a tightening path, while at the same time you're unwinding the balance sheet.
Sure, it's kind of juggling 3 balls, right? Or you got your foot on the gas and foot on the brake.
floor? I mean, what happens with all of that? Do you have any insight into how you think that all plays out?
Well, I think the tax cut, which we call a tax cut. It's not a tax cut for me. It's a tax cut for some people, cosmetically, at least for a while. We'll see what the plan looks like later on.
Reform,
but I think if there is a net tax cut, it has to be bond unfriendly. We already have growing bond supply. We've been years, thanks to quantitative easing, of negative net bond supply, really, from sovereign bonds in the developed world. And that's going to flip because the Fed is now letting bonds roll off, the budget deficit is increasing, a tax cut would increase the deficit further. And to the extent that a tax cut might be stimulative to the economy, that's bond unfriendly because bonds don't like economic growth. And also, it's just more bonds, expanding the deficit, so even more supply. So it seems to me that interest rates should continue to rise as we move into 2018.
I spoke with Lee Cooperman last week, who mentioned the tax plan and some of the ideas that we're talking about now and maybe the unintended consequences of all that, some of the risks. I wanted to listen to what Lee Cooperman had to say, and we can react on the other side.
I think the tax package makes long-term sense. Short-term, I think it's dangerous. We have a reasonably rapidly growing economy. We have a tightening regime from the Fed. We have balance sheet normalization by the Fed. I don't know that we needed additional fiscal stimulus injected into the economy.
By dangerous, what do you mean? What could the fallout of it be?
Well, you could just see a rapid escalation in inflation and interest rates, which the market's not prepared for.
Kind of talking about the same thing, right?
Similar, yeah. It's funny, Lee says normalization. That's funny how that's the word we use for quantitative tightening. But yeah, I don't know about rapid rise in inflation or rapid rise in interest rates. I think interest rates, historically, the pattern is quite convincing that they bottom in a very gradualistic fashion. But interest rates bottomed, 6-7 years ago on the 2-year Treasury, and a couple of years ago, or even 5 years ago, on 5 years and 10-year Treasuries. And so they're in a rising mode. But also, some of the inflation indices are showing a little bit of life. I mean, you've got the PPI that was released yesterday, and that came out at about 3.1, and the trend there is pretty strong. I mean, it's a linear trend off of the negative PPI that was caused by oil. And now, of course, oil is largely unchanged year over year, so that effect is gone. But PPI seems to be an uptrend. There's another gauge that people don't look at very much, but we do here at Double Line. It's called the underlying inflation gauge that comes from the New York Fed. And that was dead sideways since 2011 into about 2016. I mean, there was no life at all. And all of a sudden, it's gone up by a percentage point from 2% from the sideways days to 2.96, let's call it 3% today, and it's trending higher. So these things are interesting. Also, Sweden just printed a surprisingly high inflation number, and they're down at 0 interest rates. And then you've got England, the UK just printed a 3-handle inflation rate, and they've got very low rates. So yeah, putting some stimulus on top of the economy certainly seems like it's not going to dampen the inflationary forces. And so it's possible that we start to see an inflation narrative develop in 2018. The one thing that's still missing is average hourly earnings, which did show some life, going from 2% up to about 3%, but now they're kind of
still under
back down.
Expectations. Still
at 2.5%, and it really is somewhat surprising given all of the anecdotal evidence. When you look at surveys of what's your biggest problem, Mr. CEO, the answer these days is finding good workers. So wage inflation could start to become, although it has been missing in action, we do need to see the whites of its eyes to believe in it because it's been predicted wrongly for such a long period of time.
It sounds like you do expect, though, bonds to crack, so to speak, before stocks do.
I think it's bonds cracking that could be a catalyst for stocks. I also think a buy the rumor, sell the news on the tax package could be a short-term
which we've
peak.
been openly wondering about as well.
Yeah, I mean, it's been a nonstop upward movement. And again, I do believe the narrative will develop that there are negative parts, unintended consequences of negative parts to this tax package. But interest rates, yeah, I do think that they're clearly rising on the short end. The curve is flattening like crazy this year. I find it entertaining that every time the curve flattens, there's a narrative that develops about why it doesn't matter this time. Remember, 12 years ago, the curve was flattening, and the narrative was, don't worry about it, it's the Chinese. They're buying our bonds, and that's causing an irrational bid for the long end, and rates are down. But that was wrong because the Chinese were buying the short end. If anything, the Chinese buying would have steepened the curve. This narrative now is, look how cheap we are compared to Europe, and how cheap we are compared to Japan. Foreigners naturally will be attracted to our 10 and 30-year bonds.
But isn't that part of the reason why the curve's flattening, because of what's happening in Europe and Japan?
I think no. I think that's a false narrative. I think what's going on is if you're a Japanese investor or European investor, you're not doing well if you just own U.S. bonds. Sure, you're picking up 200 basis points or 235 basis points relative to Germany or Europe and Japan, but they have currency risk if they do that. Think of what happened to you if you're a German investor, Japanese investor, and you bought the 10-year unhedged. What happened is the dollar has dropped by about 7 or 8%. So your return is negative if in your local currency. You have to hedge the currency out. If you look at hedged 10-year yields in the United States and compare them to Japanese or German yields and 30-year hedge, you're actually much worse off in the United States than you are in either Germany or Japan. So there is no incentive for German investors or Japanese investors to buy U.S. bonds. It's a naive argument to say, look, you're picking up a couple hundred basis points. You have to hedge the currency. So I actually think the flattening of the yield curve is the real deal. It's happening because the bond market likes the Fed saying we're taking rates to 3% by the end of 2019.
Are you worried about it becoming inverted and that telling us a recession is on the horizon?
You got to watch it. Not worried yet. The 2-10 spread is one thing that I look at. It's getting close to 50 basis points. Once you start getting inside of 50 basis points, I really think you have to start watching. But none of the indicators that we follow at Double Line, we follow a lot of them, none of them flat out say worry about recession. None of them. Leading indicators are downright strong year over year. I mean, they're in a very strong uptrend. PMI surveys need to collapse from a peak before you have to worry about recessions. Consumer confidence, same thing. CEO confidence, same thing. And then the granddaddy of them all, junk bond spreads. Junk bond spreads have begun to widen by an almost imperceptible amount. But prior to the last two recessions, junk bond spreads widened massively before the BLS declared the front end of the recession had arrived. When I say massively, I'm talking 200 basis points. We would need to see that start happening. Now, one of the things that we think about is it's not so much that the junk bond market is omniscient or super smart and prescient about things. It's kind of a causal deal. When the curve is flattening, the carry trade starts to disappear. People that are leveraged investors have borrowing costs that are going up. And junk bonds are very often leveraged. So what ends up happening is as the curve flattens, the wherewithal for buyers to own junk bonds and to leverage them up disappears. And that causes a lack of buying, which causes the spreads to widen out, which causes the companies to have financial stress, which causes defaults to go up, which sort of causes the recession. It is interesting, as I pointed out earlier, that junk bonds are actually unchanged in price over the last 11 months and bank loans are down, but it's not a warning signal yet. I call it the big rock. Now, sometimes out in the country, people give directions. There's no road signs, so they say, when you get to the big rock, turn left. And people go, okay, big rock. And they say, yeah, you can't miss it. Trust me, you can't miss it, the big rock. So you're driving along, and you see a rock that's like 8 feet high, and you go, I wonder if that's the big rock. Is that the big rock? Nah, that's not big enough. And then you go a little further, and you see a 15-foot rock, and you're like, that's a pretty big rock. So you turn. But miles later, you haven't arrived at your destination. You go back. Finally, you keep driving on, and there's this rock that's like the size of 50 houses. You're like, that's the big rock, right? You know it when you see it. Junk bond spreads need to widen a lot more than they have so far to be the big rock. So we have to watch and be patient for that.
All right, we're going to take a quick break, but I just want to make sure we're clear on something. You think that bonds will crack before stocks, but you think that could be a catalyst for stocks then to crack or to push stocks higher?
Crack sounds like a very violent thing. What I'm really thinking of is that the 10-year will head up to 3%. I do believe that there is substantial support for the 10-year at 3%. I think that even foreign entities, like perhaps the Chinese central bank, might even want to stop the rate rise at 3% as a way of manipulating the global economy a little bit. But I do think pushing up for 3% will put a drag on the stock market. I think that is a catalyst for some relative value allocation changes.
Okay, that's what I thought you were alluding to. I just want to make sure we were clear on that. We'll take a quick break. We'll come back live from Los Angeles, Double Line Capital, and Jeffery Gunlach on the Halftime Report.
Next up, the traders join the conversation as we ask Dubline's Jefferey Gunlach about investing overseas and how he's positioning his positions for 2018. Plus, his take on the Bitcoin boom. Before the break, our data partners at Kensho show the top performing stocks a week after a rate hike since 2015 are NRG, Amarin, and Alliant. The worst performers, B of A, Lincoln National, Regions Financial, and Morgan Stanley. The halftime report with Scott Wapner and the traders is back in 2 minutes.
Between the market cap or the total return of the S&P 500 and the total return of something like the Goldman Sachs Commodities Index. The cyclicality is really repetitive, and it's fascinating. You go into these massive cycles. So starting in the 70s, you had commodities were extremely cheap around 1970. And then they rallied and made it to, they went from a value equal to the market cap of the S&P to 8 times the S&P. And then it reverted all the way back down. So commodities underperformed by 8x. And then you went into another commodity cycle, the one into 1998, and they outperformed. And exactly the same went back down to equal. And then commodities outperformed again going into 2011 or so. And now they're all the way back down to that level that the last 2 times, the 1970 and the bottom in the 90s. So they're about the same value. And the repetition of this is almost eerie. And so if you look at that chart, the value in commodities is like historically exactly where you want it to be a buy. And meanwhile, we have, global economic activity is increasing. We have a tax cut potentially coming and helping the economy. We continue to have absurd stimulative policies in Europe. A little less absurd in Japan, but in Europe, they're just absurd. I mean, GDP in Europe is higher, in Germany, is higher than the U.S. for the last year over year in nominal terms. Ours is 4.2, theirs is 4.3. Last quarter, we had a great nominal GDP number of 5.5. Germany's 5.6. Their inflation rate is about the same as ours. Our CPI just came out at 2.2. Theirs is at 1.8. Not that different. Their manufacturing activity is very similar. Their PMIs are at record highs as are ours, but very similar. Their retail sales are a little bit stronger than ours. You go on and on and on. So why do they have negative interest rates and all of this stimulus with 30 billion euros?
So the ECB's behind the curve. The Fed's not behind the curve.
It's remarkable that they continue this stimulus, and I think that has been a huge catalyst. I talked about at the outset of the hour. Mm-hmm. It's the global central banking has a lot to do with it. So it's sort of absurd. But it leads me to believe that commodities are interesting. Commodities were all the rage back in 2011, in particular the metals. There was a moment in 2011 where silver was at $50 an ounce, and the silver ETF, unbelievably, had more shares outstanding than the S&P 500 ETF. There was that kind of a mania going on. And that's completely disappeared. And so I think that it's an interesting time to be adding commodities. In 2011, when I went into offices of large asset allocators, they want to talk about silver. No one wants to talk about silver anymore. And so now everyone wants to talk about Bitcoin. I'm sure we'll get to that.
Oh, we will.
But I think oftentimes after a huge move, investment committees come to some rationalization of why they should buy after the big move. And they usually use the Trojan horse of diversification. Yes, we're buying silver high at $50 an ounce, but we're diversifying. Well, those conversations disappear once you go into a prolonged bear market in commodities, which basically went from 2011 until 2016. But it's already stopped. Commodities are not underperforming the S&P for the past year. They're not. They're actually doing quite well. And so it's cheap, there's good value, it's out of favor. Most investors own none, and I think it's sensible to make this the opportunity, not $50 silver, but cheap silver and cheap commodities to add to portfolios. And I think this is the time to do it.
I have, as I said, Joe and Josh, John and Peter back at our headquarters. Joe, why don't you go first with Jeffrey?
Thank you, Scott. And Jeffrey, I love the take on silver and gold. I would agree with you, and most investors right now, they don't want to even hear that conversation. But going back a little bit, it sounds as though the fixed income investor is in for a difficult 2018. What type of impact do you foresee on the commercial mortgage-backed security market as well as the muni bond market?
Well, I don't expect much effect on the commercial mortgage-backed securities market. There's a lot of securities in that market that are a 10-year maturity. So you have interest rate risk involved in those assets, and most products have tightened in their spreads. That includes commercial mortgage-backed securities. It includes munis, frankly. It includes junk bonds for sure. And so I think there's really no place to hide when it comes to interest rate risk or credit risk. Munis look overvalued. Maybe they've gotten overvalued because people are thinking that people like me are going to get a tax increase, and so maybe munis will be helpful to them. One of these days, munis may be capped in terms of their deductibility too. Now that we've added this capping idea to the tax system, where you have capped property tax deductions and maybe capped or non-existent state and local tax deductions, it's only one step away from muni interest income being capped as well, and that could be a really big problem for the muni market. In addition, one thing that muni investors have to think about is the funding status of the municipalities in which they're investing. If you take a look at Illinois or Chicago, the city, I mean, the pension systems are so egregiously underfunded. It just seems to me that the floating of those bonds, I think in Illinois there were some bonds floated at 3 3/4% yield. That just seems absurd to me. So this is a tough period. It's been a tough period, frankly, for bond investors. When we look at performance of an index of bonds, it's only done about 2%, 2.5% per year for the past like 6 years, 5 years, 4 years. This year, you know, it's a little bit better. You're doing about 3% on a bond index. But bond investors really should be being much more conservative relative to credit risk and interest rate risk as we enter 2018.
Interesting. Josh, you brought us a trade at the very end of Friday's program, and I wanted you to run it by Jeffrey to see what he thought, and it regarded the tips that you said you had recently gotten into.
Well, so we've been long tips, and one of the things that the investment committee is talking about is exactly what Jeffrey is talking about. This might be the first year in a long time where being concerned about inflation doesn't make you look ridiculous by year-end 2018. And actually, to Jeffrey's point, commodities are up 2 years in a row for the first time since prior to the financial crisis. So we haven't had back-to-back years, and you are going to see a lot of interest in commodities. So I agree with what he had to say. But I guess my question to that, Jeffrey, tips are pretty straightforward. You could do a ladder, you can do an ETF, it's not hard. The commodities question for individual investors is very hard, and even for FAs like myself, the products are terrible. The 3 and 30 on managed futures make them a non-starter for fiduciaries. And a lot of the publicly traded vehicles, the ETNs and such, if they don't have a K1, they have contango problems. If they don't have contango problems, they have counterparty risk. For example, if you buy the UBS issued product, that's what your credit risk is, the issuer. So how would you get around that? What's the answer?
Well, thanhanks for the incredibly fat pitch, Josh. The double-on strategic commodity fund
I knew that
is the answer to that problem, and it avoids all the things you're talking about. So take a look at that one. But the tips idea is interesting because I was negative on tips for 10 years. I was negative on tips and negative on financial stocks for 10 years, from 2006 to July 6th of 2016. When we turned positive on tips because we thought the inflation expectations that were priced into tips versus nominals, that's when the 10-year Treasury was down at 132 intraday, was just absurd. I mean, they were talking about this incredibly low inflation rate existing for the next 10 years. So we bought tips for the first time, and we've traded in and out of them. But tips are strangely attractive to me. I think they should have done better recently than they have. In the sell-off of the 10-year, from 202 intraday up to where we are today, about 238, we were about 10 basis points higher. Tips actually didn't outperform, which is odd, because what raises rates usually is something about inflation expectations. So I think tips are a good vehicle to use at the present time. And in particular, it seems to me that shorter-term tips, where you don't have any kind of interest rate effect, although tips have less interest rate risk anyway relative to the inflation tie-in, they seem pretty cheap. It seems to me that it's a good time to be owning those securities as part of a bond portfolio.
Let's jump right back to Washington, D.C. for a moment with more breaking news with our Ilan Moy on the tax developments. Ilan?
Scott, we just heard from two Republican senators who have been on the fence on the tax bill in the past and whose support is critical to getting this done. Senator Ron Johnson of Wisconsin and Susan Collins of Maine. Senator Johnson said that he is reserving his judgment on the tax bill until he sees the final details. He had wanted to see a bigger deduction for pass-through businesses, but he did say he was happy to see the corporate rate inch up to 21% in the current version of the bill. Susan Collins also said she won't make a decision until she sees the final text, but she said that the issues that she cares deeply about are being addressed in the negotiations. So they are withholding judgment for now, still possibly a yes, as lawmakers try to get this done and locked down before the week is out. Back over to you.
I have a feeling we'll be back with you shortly, Ilan. Thank you so much, Ilan Moy on Capitol Hill. In the meantime, let's go to the White House where Eamon Javers is standing by. Eamon, what are you hearing at 1600 Pennsylvania Avenue?
Yes, Scott, a White House official just told me they believe here that they do have a deal on taxes. The details are pretty much, I'm told, what we reported they would be yesterday. The president now is meeting with some of the conferees, the Republicans on both the House and the Senate. They're having a lunch here at the White House to go over some of those details, but it would seem that they've gotten this agreement just before that lunch actually started. Now, the White House has just called reporters in to go tape the top of that lunch. That was something that they were not going to do. It was going to be a private behind-the-scenes lunch, but now reporters are going in. So it's possible that within the next couple of minutes we could hear something from the President of the United States about that. You can imagine reporters will want to ask him about the tax deal, the specifics there. Also, the Alabama Senate race last night and some other political questions swirling around this White House this morning as well. So be prepared to hear from the President any moment now.
We will. Eamon, and we'll go live to the White House for that. When we have it, Eamon Javers on the North Lawn. So if you, Jeffrey, think that this could be a sell on the news event, is that yet another reason why you continue to favor parts of the emerging markets over the United States as we enter 2018?
Not really. I think if there's a setback in U.S. stocks, you probably have setbacks in global stocks as well. It's really much longer term orientated. Emerging markets ex-China had underperformed the S&P by a massive amount from 2011 into 2017, 2016. And it's strange because there had been a very tight relationship between the percentage of the market cap that emerging markets represents versus the global market cap and the GDP share of emerging markets versus global GDP. For quite a few years, they tracked each other exactly. And starting in 2011, they began a massive divergence because, one, commodities started to fall, and commodities are obviously emerging market oriented, and also the dollar, not unrelated, started to rally. So you had an incredible underperformance of emerging markets over that time period, and so they're incredibly cheap. With a Dr. Schiller's CAPE ratio that we use on one of our stock funds as a metric, basically half. Even with the outperformance of emerging markets over the last several quarters, the CAPE ratio remains only a little more than half that, but about half that of the United States. And beyond that, when you talk about emerging market investing, you have to start with the dollar. If the dollar is going to be rallying, you really don't want to be in emerging markets versus U.S. stocks as a U.S. investor. But I don't believe, but clearly the dollar has not been rallying. Yeah. It's been falling all year. It's rallied since August, which can be expected given the magnitude of the sell-off. But I believe that the dollar is going to fall again after this correction runs its course. It was down at about 91 or so. It should make it up to about 96 on the Dixie. It was at 94 or so yesterday. So we're not talking about much of a rally. But I think after that, the dollar will take another leg down. And for that reason, you have valuation on the side of emerging markets, you've got economic growth on the side of emerging markets, and you've got the dollar that I think will favor it. So I've been maintaining that position, even though I expected a setback with the dollar rally that's going on. This is a long-term idea.
You've zeroed in really on India, right?
I've loved India for years.
ETF.
I've loved India for years. I continue to love it. INDA is an ETF that people can buy. It's up about 30% year to date. And the basic dynamic there is that if you take the template of China over the past 35 years, you can overlay that on the situation in India, I believe. So I know when I first recommended India about 5 years ago, everybody threw up their hands and said, oh, you know, there's crony capitalism, pay-to-play legal system, there's regulatory issues, there's so much glue in the gears. And I say, yes, it means it can get better. And they actually have to make it better to open up their economy because their labor force is going to grow by 200 or 300 million people over the next generation or so. That's what happened to China. They had a couple 300 million people that joined the labor force over the past 30 years or so, and you have to have jobs for those people, or else you're going to have riots and political instability. So that needs to happen. And so I believe India has the most powerful demographic story and the most room for improvement. And similar to other emerging markets, ex-China, I say, stay long, don't open the statement. Because when it goes down 8%, and it will, you might panic and get out. What you want to do is stay in for your grandchildren's college education.
Okay. Speaking of panicking and maybe getting out, there's a whole intro written for Bitcoin. I'm not even going to read it. I'm just going to. What do you make of Bitcoin?
Well, it's in the big rock phase. I talk about junk bonds. Wait for the big rock. I think we're starting to see the big rock in terms of silly season. One of my corporate bond traders pulled up something called CryptoKitties, which is a new attempt at some sort of cryptocurrency. It's a picture of a cat, and each picture is unique. And apparently somebody bought one for $100,000, and I think they're trying to flip it for $400,000. I mean, this is the kind of nutty stuff. And the fact that we're talking about it 24/7 puts us back into like where silver was in 2011, where everybody wanted to talk about silver. And then remember Apple in 2012? I've kind of famously said short Apple, go long natural gas, and it actually did drop about 40%, Apple did. And one of the reasons was I was watching CNBC. I was traveling, and it had on the hotel room, and one fellow came on. That's before pre-split, so the stock was at like 600, 700. Mm-hmm. And one guy came on and said, my target's 1,000. And I'm like, that doesn't sound like there's much analysis behind it. Nice round number. And then an hour later, someone came on and said 1111, which I like because it's two double lines, 1111. But that again.
I know of the analyst in which you're referring.
It sounds kind of silly. And then another guy, not to be outdone, says 1,500. So he gets into this nutty kind of thing. And now I saw on CNBC yesterday there was somebody putting out the million number, a million. 20 years from now, I think he said, but still a million. You're getting to the point where you're trying to get notoriety for how high a prediction you can make. And the fact that we're talking about it so constantly reminds me of another thing on CNBC, which was in January of 2016. I was about to do my Just Markets webcast, which is my biggest one of the year. It's actually coming up on January 9th. People can sign up at doubleline.com. But what I do is I talk only about markets, no funds, so that we can make all kinds of forward-looking statements. We're freed of a compliance regime that surrounds any time we talk about our funds. But I was about to do my Just Markets webcast, and I was watching CNBC to make sure that I was right up to the minute, because if something happens, you want to be on top of it. Yeah. And what was going on was the show for like 2 hours was oil, WTI, tick by tick. It was actually on the screen, tick by tick, and it was about how low can it go. It was at $26 a barrel, and somebody came out and said it's going to 25. As if that's some kind of a forecast, right? It went from 95 to 26, and someone's trying to make a name of themselves by saying 25, as if that's any kind of a forecast. And then somebody else comes out a minute later and says 20, and then Standard Chartered Bank, who's almost always the one that goes and does the extreme thing at the absolute turning point, said 10. And so I said, I'm massively bullish on oil because of this idea that we're following it so intensely and obsessively about how it's been falling, it's going to fall further. That seems to me where Bitcoin is right now. Now, can it go higher? Sure. I mean, I turned negative on the NASDAQ in September 30th of 1999. Now, if you shorted the NASDAQ, September 30th, 1999, you ultimately made a killing. However, in the fourth quarter of 1999, I think it went up 80%. So you absolutely got buried if you were short. But ultimately, it worked out. I think if you short Bitcoin today, you'll make money. Can it go higher? Of course. It's in a massive momentum sort of a deal. But CryptoKitties, to me, that's the big rock. Something's wrong here.
You don't own any?
No, that's not for me. I'm very conservative. I have no interest in this type of maniacal type of trading markets. Sure, people make a lot of money. My mother, she's 86 years old. She sent me an email with a link from her cousin's daughter about buying Bitcoin and why you should get in now on the ground floor. And she said, what do you think? And I said, Ma, usually this type of activity doesn't come up at the bottom. Usually it comes up closer to the top.
John Najarian, you have something for Jeffrey on Bitcoin?
Yeah, absolutely. Jeffrey, great to have you with us on the show. And to that Bitcoin question, I remembered reading that your mom had texted you that. And I remembered at the time because Pete and I had just met with Peter Brigger over, obviously, of Fortress and so forth. And just about the same time you were talking about that in an article about your mother texting you that, I remember it was under 4,000, roughly 3,800 or something like that. And now here you are.
I think it was 4,500, but you're close.
Okay.
Yeah.
And now it's 5 times or at least 4 times higher than that right here. So it's, if not Bitcoin, are there any other cryptocurrencies that you would focus on because perhaps you think Bitcoin is too far too fast? Are there any others that you would look at or anybody else? I know guys in your office are talking about it every day.
Yeah, you've got that right. We've got one of our guys that bought it a couple years ago, and he's, he's feeling it, right? So, no, I would, if I was going to buy a crypto, I would buy Bitcoin. That's the one I would buy. Certainly, I wouldn't buy crypto kitties for sure. But I would stick with Bitcoin. It's the one that is, it has the real trading volume and the like. And there's a lot of weird pink sheet stuff that's going on around, some of these third-tier cryptos and companies around that. I wouldn't touch that with a barge pole, but that's just me. I'm just very conservative. I'm not interested. I'm a buy low guy, okay? That's basically what I do. When something has gone up a lot, I am not a momentum player. I don't like buying things on momentum. Bitcoin is a massive momentum play. It just doesn't suit me at all.
Do you think it's legit, though? In this conversation of whether, you have some people saying it's a fraud, others arguing back, no, it's legit.
I don't think it's legit. I actually...
You don't think it's legit?
No, I don't think cryptocurrencies are legit. I think that ultimately they will not serve the purpose that people think that they will serve for a couple of reasons. First of all, I don't believe that they're ultimately unhackable. I know the 20-year-olds that know all the stuff, the masters of the universe, they tell me I'm dead wrong. But I'm a philosopher, kind of, and I believe that what can be done can be undone. And so I think ultimately that they won't serve the purpose. And beyond that, I don't think they will free you of the government's control, ultimately. And I think that's one of the reasons people kind of believe in them. I actually think it's the other way around. I think the government will be particularly able to control it. No more suitcases full of $100 bills. If you have Bitcoin, everything can be followed. And I do believe that some of the technology, the key technology that's behind these cryptocurrencies was developed by the NSA. Now, if that's true, then obviously the government has some knowledge of what's going on behind the scenes. So just on a philosophic basis, I don't really believe in them. And I also think governments will fight tooth and nail. If they can't control them in any way, they'll fight tooth and nail to suppress them because there's a complete inconsistency between a cryptocurrency world and a world of nation states.
Interesting. Ilan Moy has another update for us back in D.C. regarding taxes. Ilan, what have you picked up now?
Scott, I'm now hearing from 2 sources that the corporate alternative minimum tax will not be included in the final version of the bill. It had been repealed in the House version of the bill, but the Senate version of the bill had kept it, and companies were worried that by keeping the corporate AMT, you were essentially undercutting the benefits of a lower rate. But now hearing from 2 sources that the corporate AMT is out. Back over to you.
Anything you're hearing on first in, first out, which Ilan, we've been covering almost every day on this program?
Yes, I know it's extremely important to us, and I did ask Diane Black, who is chairwoman of the Budget Committee and one of the tax negotiators, about this very issue this morning. She said it's still part of the discussion, but did not hint which way they were leaning. Yeah,
we'll see if there are any developments on that. Ilan, thank you so much. Just quickly, you're shaking your head on this first in, first out thing. Larry Kudlow's called it the dumbest thing he's ever heard of.
There's a lot of things about this tax plan that are being discussed that are troubling to me. The kind of micromanagement of it is troubling to me. This first in, first out thing, it's just, they're trying to nickel and dime, find ways to squeeze yet more money out of investors and out of people like me. And I don't mind paying taxes. I actually feel it's a civic duty to pay taxes. But what really gets my goat, and Stan was on with Kelly, Stan Druckenmiller yesterday was on with Kelly about this carried interest thing. I mean, how many times did candidate Trump go on the campaign trail and rail against the unfairness of the carried interest deduction. He did it a lot. It was one of the things that was one of his talking points on his stump speeches. And somehow carried interest survives in this tax plan. And I think Stan used the word offended or offensive, and I couldn't agree more. That it's just unbelievable to me that survives in a context of trying to have a tax reform. And then beyond that, you've got this idea of the pass-through rate, which sounds kind of interesting, but they specifically call out investment management businesses as being a service company that cannot do the pass-through. And it's sort of like, I don't know, it's the surgical nature of this, like calling out, you're a winner, you're a hedge fund billionaire, and you're a winner on carried interest, and you can be a small, we're not small, but there can be a smaller money management firm, and for some reason they're doing exactly the same activity. They're trading securities, they're investing other people's money, they're making income off of their fees, and yet they're being treated completely differently. To me, it doesn't sound like draining the swamp. It sounds like maintaining the swamp. So the tax package, it really bothers me. And also, of course, the deductibility of state and local taxes it seems almost vindictive because those are the states that didn't vote for Trump.
I mean, you supported Trump. You voted for Trump.
Well, I voted for him over Hillary for sure, but I didn't support him. I predicted he would win way back before the primaries started. That doesn't mean I necessarily support him. I'm not a Trump hater. You know, I like some of the things he does. I dislike some of the others. One thing about Trump that's very strange is his grasp of the truth is imprecise. He doesn't have, like, even though the way he speaks of his policies, it's imprecise. It's like the truth is a range, kind of, and he approximates what he's going to do, and it's sort of a close enough type of approach. It's a very odd way of operating, but he promises things that don't get delivered a lot because he's approximating in terms of what he says he's going to do.
Jackie DeAngelis, we'll jump back to headquarters to you for Futures Now.
Thanks, Scott. Well, copper rallying 1% today. We're watching that very closely. Higher for its sixth straight session.
Appointing Jay Powell. Is he going to be a good Fed chair? Do you think that's... I mean, you threw out Neil Kashkari's name. That wasn't real.
No, it wasn't real. It was to make a point about the desire to not have a hawkish person in there. But Powell is... kind of a status quo sort of a pick. I actually think it's a slight upgrade. I don't dislike Janet Yellen. I mean, her legacy is going to be
good marks.
Her legacy is going to be strong. I mean, she got us off of 0. She raised rates a number of times. Looks like it's going to be 5. Maybe, and she started normalizing. Well, I call it quantitative tightening, and nothing fell apart.
I got to interrupt you. Let's go to the president.
Thank you very much. Thank you, John. Thanks, Mr. President.
All right, that is the President of the United States at the White House there speaking about the tax plan. We're really very close, said the President, close to a historic victory. Tax cuts the likes of which we have never seen before. Also there at the end said he would, quote, be thrilled with a corporate rate coming down to 21%. We're spending our final moments now with Jeffery Gunlach of Double Line Capital. Do you want to react to what you just heard from the President?
Well, I'm not sure the facts are exactly as stated. I think the average corporate tax rate effectively is 21% right now. And so it sounds like it's going to be changing in terms of the composition of who pays what, but on average it will probably be about the same. And if this is indeed the massive tax cut that he describes it as, I would just point out to the viewers that the Reagan tax cut led to an explosion of the debt-to-GDP ratio in the United States, and the George W. Bush tax cut led to a gentle and then accelerating rise that ultimately led to a massive rise in the debt-to-GDP ratio. So if what he's saying is true, and this is the biggest tax cut ever, seems to me that it's bond unfriendly.
All right, well, we'll see how it all shakes out. Thanks so much for your hospitality today.
Thanks for coming.
It's been great being out here. Again, with Jeffery Gunlach, the Bond King, Double Line Capital here in Los Angeles. That does it for us. We'll send it back east now to Power Lunch.